What if I told you there's a tool out there that claims it can pinpoint market bottoms with almost scary accuracy? Well, in this explainer, we're going to dig into an indicator that says it can do exactly that. I mean, that's a pretty wild claim, right? The source material for this whole thing kicks off with that quote, and you're probably thinking the same thing I was. That just sounds way too good to be true. And yeah, that's the million-dollar question, isn't it? It's one thing to look back at a chart and see all the perfect signals. But does this thing hold up in the real world when your money is on the line? That's what we're about to find out. So, here's our game plan. We'll start by looking at this promise of a perfect bottom finder. Then I'll introduce you to the indicator itself, the VIX Fix. But we're not just going to sing its praises. We're going to get real about its two biggest flaws and then build a two-indicator strategy to fix them. We'll even cover some advanced stuff before we land on the one key takeaway you absolutely need to remember. Okay, let's just look at the promise here. You pull up a chart of, say, Bitcoin or Tesla, and you see these little green flashes that seem to appear like magic right at the bottom of a nasty dip, just before the price rips higher. Seriously, it looks like a crystal ball. But to really get it, we need to pop the hood and see how it works. All right, so let's pull back the curtain. The tool we are talking about is totally free, and it's available for anyone who uses TradingView, which is one of the most popular charting platforms out there. The full name is the C.M. Williams VIX Fix, and it was created by a guy named Chris Moody. The cool thing is, this isn't some secret, expensive tool Wall Street is hiding from you. It's a community-built indicator you can literally add to your charts in the next 5 minutes. So, what's its job? In a nutshell, the VIX Fix is built to sniff out potential market bottoms by looking at volatility, and it's super versatile. You can slap this thing on stocks, crypto, Forex, pretty much anything that has a chart. The whole idea here is actually pretty simple. You'll see these bars on your chart. Longer bars mean volatility is cranking up, shorter bars mean things are quiet. It's all based on a classic market idea. The moment of maximum fear, when everyone is panicking, is often the absolute best time to buy. So when this indicator thinks that fear and volatility are getting way overstretched, it flashes green, signaling, hey, a bounce might be coming. But like we said, no indicator is a magic bullet. And if you just started blindly buying every single time you saw a green flash, you'd run into two huge problems that could, completely wreck your account. And here they are, the two big killers. First, you get false signals. The indicator flashes green, you jump in, and the price just keeps on dropping. Ouch. Second, and this one is super frustrating, you get multiple signals. It might flash green, then the price drops a little more, and it flashes again and again and again. So which one is the real bottom? It turns into a total guessing game. Okay, so this is where we get to the good stuff. This is where the real strategy kicks in. Instead of just depending on one kind of flawed tool, we're going to combine it with another indicator to filter out all that noise. This is the secret to making it actually work. And our partner in crime is going to be a trading classic, the stochastic oscillator. This indicator is all about measuring momentum. So by pairing the VIX Fix's volatility signal with the stochastic's momentum reading, we can build a much more reliable, rules-based system that pretty much solves both of the VIX Fix's big problems. All right, here are the exact rules, the three-step process. Step 1, you wait for the VIX Fix to flash green. That's our heads up. Step 2, you glance down at the stochastic and make sure its blue line is hanging out in the oversold area. This tells us that the downward momentum is probably running out of gas. But, and this is key, you don't buy yet. The final critical step is to wait for that blue line to actually cross above the orange line. That crossover is our trigger. All three things have to happen, no exceptions. Of course, any strategy is completely useless without risk management, so the source lays out some crystal clear rules. Once you get all three confirmations, you enter a buy position. You put your stop loss just a little bit below the most recent low. And for your take profit, you aim for a simple 2-to-1 risk to reward ratio. So if you're risking $100, you're shooting for a $200 profit. Simple. Now, this strategy is awesome for catching those big reversals from the bottom, but that's not all it's good for. And maybe more importantly, there are some pretty big limitations that you have to know about. What's really cool is that this isn't just for, catching a falling knife. You can also use this exact same setup to buy pullbacks when there's already a strong uptrend. The price is moving up, it dips a little, and this three-step signal can give you a fantastic entry point to hop on board the trend. Now, the psychology here is really important to understand. For finding bottoms, we're looking for crazy high volatility, peak fear. But for finding tops, the logic completely flips. A market top often forms not with a bang, but with a whimper. It's when an uptrend gets really quiet, volatility dies down, and it feels like the conviction is just fading away. So, to spot those tops, the source suggests using a modified version of the indicator, and the rules are basically just the mirror opposite of what we learned. You look for a green flash to signal a potential top, you confirm the stochastic is in the overbought zone, and then you wait for the blue line to cross below the orange line to sell. But, and this is a really, really big but, the source gives a huge warning here. Based on their experience, the signals for finding bottoms are way more reliable than the signals for finding tops. Because of that, they basically recommend you stick with the original strategy for buying the dips. So, after we've broken all this down, the tool, its problems, the strategy to fix it, what's the single most important thing you should walk away with? It's this. There is no such thing as a magic indicator, period. The VIX fix by itself is interesting but flawed. Its real power only gets unlocked when you use it as an alert system, and then use another tool like the stochastic for confirmation. The power is always in the combination. And that really brings us to our final question for you. We use the stochastic oscillator here, but the principle is universal. So the question I want to leave you with is, what other tools could you use for that confirmation step? Maybe support and resistance levels, moving averages, chart patterns? The answer to that could be the key to building your own powerful trading strategy. Thanks for tuning in.